Of course, 2008 was carnage for the hedge fund industry. A lot of former high-flying operatives went by the wayside, even some hotshot big names like Ken Griffin, you all know him, Citadel, whose flagship fund dove like 55% last year. Carl Icahn, everybody knows him, lost nearly 40% last year in his main vehicle. He had to actually write his own check and stick his own personal money in to kind of bail it out. But those same funds are actually spiking this round for obvious reasons. The whole mood has shifted. Citadel's Kensington Global Strategies Fund up 20% so far in 09, and Icahn is ahead like 15 or 16%. We're joined in this segment of the program by Patrick Fauchier, partner and chairman of Fauchier Partners with 5 billion AUM, an operator in this space, and of course David Sun, China chair of ENY. Mr. Fauchier, Monsieur Fauchier, bonjour, and bienvenue. Welcome to the program. It's interesting because I was studying up on people like who you know very well, people like Steve Cohen, SAC Capital Advisors, and the other. They're actually doing really well, and May was quite a windfall month. Are these short-term turnarounds in the market, or are they building durable strategies in this space?
I couldn't speak about Mr. Cohen because we are not close to him in terms of investment, but I would say that certainly the hedge fund industry in general during the months of May have been doing quite well, and probably because there was a lot of dislocation and opportunities to catch into the market. Dislocations are exactly what hedge funds should be looking for, and when they have it, they have to use it.
In general, the industry enjoyed like a 5.5% bump in the month of May, taking the average. I mean, I realize average is a bit of a misnomer, and it's misleading because you've got all kinds. You've got lows and you've got great spikes and highs, but about 10% so far this year. So 2009 is shaping up considerably better than the year we saw last year. Question is, when the market mood turns, you buy index funds, you buy ETFs, you buy tracker funds, and they go up, and then you see hedge funds going up. You kind of wonder, how hedged are they? How leveraged are they? Are they just riding the crest, or are they actively in there micromanaging? A big question. I mean, are we on a 220, kind of a structure? Are we getting our money's worth? He's looking at the accountant, you notice that?
No, what I do believe is that the hedge fund world is a big world. Within that world you have sort of everything. You have people who are extremely leveraged, you have people who have very little leverage, you have cautious people, you have greedy people, and so of course when you are a fund of hedge fund managers, as we are, your job is to try to select people who are doing reasonably their job, taking care about risk and return. Speaking only about return without talking risk is wrong.
David, as an auditor, I'm sure you've been sent in to do the mop-up, sort of the post-mortems on a lot of these funds during the breakup period, which we saw last year. I know a lot of 2- and 3-man bands, boutique hedge funds, which called it quits and decided it really wasn't worth it with the crazy bouncing around, and they couldn't really stay ahead of the curve. What kind of trends have you noticed in Mr. Fauchier's space from your perch of view?
Well, from the investment standpoint, we are seeing, of course, like what you have already observed, the market's going up. But from looking at the hedge funds industry as a whole, there's a lot more with what's happening in the last year. And recently, there's a lot more emphasis when we look at the books on the custodian area of the hedge funds, as well as any counterparty risks that they are facing and how they're managing it. And I think the hedge funds managers that we are looking at certainly have placed more emphasis in those areas as well.
Is that pretty much the sense you get among your peers, Mr. Fauchier?
Yes, of course, again, it's a large world with plenty of people making things in their own ways, but clearly there is a sense of coming back to the roots in general for the profession, coming back to what they know how to do best, and all the people who have been a bit too creative are disappearing. One
of the sort of the quirky aspects of the industry is a lot of people in this space forgot why they were in this space. They left the word hedge out of what they did. In fact, they adopted so much beta in trying to achieve ultra high alpha. They took on risk which was which was very, very uncorrelated with what their mandate was. I think we have some, I believe we have some graphical charts to illustrate just exactly how your organization has been doing. I'm going to try and see if I can get those out of the system. But if I look back to 1995 to present time, you have been a lot steadier than, like the world index. And we're just showing you some of the assets by client type here so we can see the kind of demographics that Patrick and his firm covers. But I noticed that you don't experience the same highs, you don't experience the same lows. Your volatility is far less than like a benchmark like the MSCI World Equity Index. And looking at some of the worst months, you've outperformed in just about every down period, which tells me that you are very, very hedgy.
Yes.
I think that's the technical term, right?
Well, because first, if a hedge fund is translated, in French they translate hedge funds by speculative fund, which is quite amazing because they probably never got a dictionary about it. So hedge funds should protect your money. And so accordingly, if you had the same volatility on the market, that would be wrong. The beta, i.e. the strength of the market into your portfolio, should be a lot lower. And if you want to respect a rule given by Warren Buffett, you are rich, you want to stay rich, the first rule is do not lose money, then I think losing money is very asymmetrical. When you lose 10%, you have to make 11%. When you lose 40%, you have to make 70%.
Clear, yeah, my mother taught me that too. Susie Orman taught me that when I was working with her at CNBC. Quick question for you on strategy for the rest of 2009. Last year, the CTAs, the commodity trading advisors or the managed futures funds, whether systematic or discretionary, seemed to do a bang-up job. They were sort of stars last year. Volatility is very low if you look at the the ups and downs and the zigzags. What is going to work this year as sort of a global macro arbitrage or convertible arbitrage? What's really going to nail it down?
Yes, well, I believe that there are good ingredients for having macro, which should do quite well. Normally, we should have good strategies related with credit, should be interesting. Cyclically, the convertible arbitrage should also be good. And as always, long-short equity should be good.
Okay. Mr. Fauchier, thank you for spending time with us. Okay?
Thank you very much.